Good afternoon, ladies and gentlemen. Welcome to today's economic briefing. I'm E.A. Aguirre from Metrobank's Institutional Investors Coverage Division, and I will be your host for this session. Thank you for joining us today as we discuss the latest developments in the global economy and financial markets. Today's agenda delves into key topics like the U.S. and Philippines' projected performance, emerging markets, and wealth management strategies. Our esteemed speakers and panelists will share their valuable insights and thought-provoking perspectives to help you navigate this economic landscape. Now, to formally kickstart this session, may I call on the head of Metrobank's financial markets sector, Toto Tansinko.
Good afternoon. I'm Toto Tansinko, and on behalf of our chairman, Arthur T., our president, Fabian D., and the markets team of Metrobank, I'm glad to welcome you to our 2024 mid-year economic briefing entitled Navigating the Easing Cycle. What do J. Paul Getty, George Soros, Warren Buffett, and Jeff Bezos have in common? They all created great wealth during market turns. Whether the Great Depression in the 1920s, the demise of the gold standard and oil shock of the 1970s, the exit of the pound from the European rate mechanism in the 90s, or the dot-com bust in 2000s, great opportunities abound when markets realign. These are the ones who took advantage of opportunities while the rest of the world was still stuck in the old paradigm. On the other hand, the demise of Archegos, Lehman Brothers, and Peregrine Capital are a reminder to us of the consequence of the failure to adapt. Today, we are at another market turn. In 2022, the highest estimate from the dot plots of the Fed governors themselves was only a 4% Fed funds by 2024. We now see how wrong they were. Now, these same dot plots predict a rapid decline in interest rates to 3% by 2026. Will they be right this time? A lot of questions need to be answered. Will the Fed and other central banks finally cut interest rates, or will rates remain higher for longer? Can we survive higher forever? How will the rise of AI, geopolitics, global warming, and the political landscape transform the market? What are the opportunities in the credit market, foreign exchange markets, and the stock markets in the next few months? But most importantly, how can we anticipate and adjust to these changes and take advantage of these opportunities to enhance our wealth? In this exclusive market and economic outlook session, we hope that we can provide you with some insights that will enable you, our valued clients, to make better investment decisions. You will hear from Ruben Zamora, who has oversight of our market strategy of Metrobank, to give us the Philippine-focused outlook, and Pramod Shanay from our partners CreditSights to give us a global view. We in Metrobank are committed to be your trusted advisors, and it is our privilege to guide you through this market turn. Let me end with a quote from George Soros, which is good to keep in mind during these times. Money is made by discounting the obvious and betting on the unexpected. Thank you, and I hope you will find great insights in our briefing.
Thank you, Toto. Before we move on to the next part of our program, may I remind everyone to please reserve your questions for all our speakers. We will have a Q&A session towards the end of the program. You may send your questions via the Q&A button at the lower right corner of the screen. Our first speaker, Pramod Chenoy, is the head of research for CreditSights in the Asia-Pacific region. CreditSights is the largest independent credit research company worldwide. Pramod joined CreditSights in 2019 to head Asia-Pacific research for financial institutions, for which he continues to be responsible for. Prior to joining CreditSights, our speaker spent 17 years in debt capital markets, covering financial institutions' clients in Asia and Europe. Please welcome Pramod Chenoy.
Good afternoon, everyone. Thank you for taking the time to join us today, and also thank you to the Metrobank team for inviting CreditSights for this presentation. I am just in the process of sharing my screen, and there we go. Over the course of the next 20 minutes or so, I am going to walk you through the outlook that we see in the US. Where is the US right now? What kind of trajectory is it on? What is our expectation as far as rate cuts are concerned for the near future? From there, we're going to move on into a little bit of emerging markets, a little bit of Asia, and then the trends and themes that we are seeing in the fixed income markets. Let's start with the US. Toto had some interesting dot plots to show you earlier in terms of what the Fed thought we would be in 2024. What this slide shows you on the left-hand side is GDP growth, trend GDP growth over a long period of time. The deep dip that you see on the left-hand side is COVID, and US GDP, while it's been doing reasonably well, still hasn't caught up with the levels that it would have been pre-COVID. And that's despite a significant amount of stimulus that was provided during the COVID period. And more recently, we've also seen a lot of fiscal stimulus provided by the government. Now, this is in the form of the Inflation Reduction Act, which is a lot of incentives that are being passed on to consumers as well as manufacturers. There's the Chips Reduction Act, which again is a lot of incentives that is being provided to manufacturers to move the chips production ecosystem away from China into something more US centric. And there are also a lot of forgiveness of student loans. So all of these, once you add them all together, there's a lot of money which is in the hands of consumers. And this is on top of the extra boost that they received during COVID. But you can see on the chart, which is on the mid part of the page, that consumer spending has been robust leading up till now, but there's been a little bit of faltering that's happening. So what we see is actually a little bit of a slowdown that's taking place. We have had certain economic data that has come out that has surprised to the upside, more recently around jobs and the number of jobs that have been created last month. But a lot of the data is actually pointing more towards the downside. And this is not just the official data, but at CreditSights, we have a lot of analysts that are covering a number of different industries, and we are seeking a lot of different feedback. And as part of that, we can see that at least consumer spending seems to be slowing down. And we can also see that corporates are also becoming a lot more cautious. So the first quarter US GDP growth was below par. It was at about 1.6%. Forecasts, by the way, for the year are about 2%. So we are trending in the first quarter well below that. Discretionary consumer spending, as I mentioned, has started to slow. And this is seen not only in terms of what people are buying in stores, but also in terms of slowdown on credit card spending. So you can see that higher interest rates are slowly making an impact in the US. Companies are managing their wage bills very carefully. So whereas minimum wages have gone up in a lot of places, for those companies that are actually hiring more on the go, what they've done is that they've reduced the number of hours worked for their employees. So that has ensured that their wage bill isn't spiraling particularly out of control. Now, the challenge to this is strong jobs growth. So what we have seen once we have dissected that particular data is that a lot of that jobs growth is coming out of the government sector, where there has been financing, and some of this is still COVID-related financing and the other financing that I talked about, the Inflation Reduction Act, the CHIPS Act. So there's various funding that's there at various levels of government. So some amount of government hiring is happening, but we don't anticipate that continuing forever. And continued hiring taking place in the leisure and hospitality space. And again, there was a big drop in that sector during COVID, and the catch-up has broadly happened so far. So we're not really expecting a lot more of hiring to follow. So we anticipate that hiring is going to slow down a little going forward. The delta in this is manufacturing. Can manufacturing pick up? We had some recent manufacturing data that looked pretty positive, but the long-term trend in manufacturing has not been good, at least as far as the US is concerned. So the slack that is coming in from the consumer is not likely to be picked up elsewhere in the system. Let's go across to the Fed. But before we go into the Fed, let's see how yields have performed on US Treasuries. And in the chart that you have in front of you, what we've shown is the 2-year US Treasury and the 10-year US Treasury curve. Way back in December 21, the 2-year Treasury was well below 1%. The 10-year Treasury was, call it about 1.5%. And you can see that as rates have increased in 2022, you've seen a big increase in terms of yields. And an interesting switch that has taken place, which is that the 10-year Treasury is now trading below the 2-year Treasury, and that has been the case for a while. It's been the case for the last 24 months since June 2022. And the reason for this is that the 2-year Treasury is more tethered to where the Fed funds rate is, whereas the 10-year Treasury is more an outlook of where the long-term nature of the economy, what does economic growth look like, what is a sensible long-term yield rate for the economy. And in case growth is not particularly strong, that automatically gets tethered a little bit downwards. And so we have had this what's called inversion of the curve between the 2s and the 10s more recently. What does that mean more prosaically? What that means is that yields on a lot of bond issues tend to be the same. Typically, you tend to have, if you have a longer a duration bond, then you tend to get some pickup in yield. But if you are buying a corporate bond, what's happening is that as there's an increase in spread from 2 years to 10 years, that's offset by the fall in yield. So broadly, whether you're buying 3 years or you're buying 10 years, for a lot of issuers, you tend to find that the yield is broadly the same. So that's what's happening in the Treasury market. Now, the Fed, in its latest guidance, which came out only a few weeks ago in June, expects GDP growth to be 2.1% this year, unemployment to be about 4%, which is where it is right now. And in the dot plots that Toto had given you a snapshot of, which is the forward expectation of where rates are going to grow, the median dot plot was for only one cut by the year end. We are seeing softer trends than the Fed. The Fed is very focused on all of the information that is coming in and live. But for more forward-looking information, we are definitely seeing indications of a slowdown, as I'd mentioned earlier. And that's also something that the market is also seeing. So whereas the Fed is saying that there's going to be one rate cut, the market, which we can see what the forward-looking curve looks like, what are expectations built in, that anticipates that there are going to be 1 to 2 rate cuts by the end of this year. We are in the more dovish camp, and we believe that the right thing for the Fed to do to balance out growth and inflation, which we can see has steadily been falling, is for 2+ rate cuts. So we are anticipating, we would hope that the Fed is going to cut rates in September. There are also meetings in November and December. So those kind of are the landing points for when we anticipate that cuts will take place. The 10-year US Treasury is at 4.25%. We anticipate by the end of the year, it's likely to fall to 3.75%. What does this do as far as markets are concerned? On the left-hand side, you can see a bar chart that shows the funds that are flowing from retail investors into US investment grade. And what you can see is that the movement has been pretty good this year. And in fact, although we are just in the second half of June, what you can see is that we've already hit 75% of 2023 inflows. So retail investors do anticipate that rate cuts will be good in terms of performance. They also like the yields which are there right now in the markets, and so they're happy to participate with their dollars into the US IG markets. One thing to note is that the U.S. money market funds, which have ballooned over the last few years to about $6 trillion US. $6 trillion US is a humongous amount of money. Just for comparison, during the last decade, during the 2010s, U.S. money market funds were broadly in the $2.5 to $3 trillion range. So they've doubled in size, and this is like trillions of dollars worth of money. That U.S. money market fund size has been pretty consistent over the last year and a half. And that's because there are a group of investors that have parked their money there. They're getting a good amount of income, 5% plus, 5.25 plus on just short-term rolling over bills every 30 days, every 60 days. And they're happy to park their money there till such time as they have greater evidence of those cuts coming through. What we do anticipate is that once the first sign of cuts take place, then you will have money moving out of those money market funds into fixed income funds and indeed other asset classes. And what that is going to do is that's going to tighten yields and spreads. So there's a huge amount of money that's waiting on the sidelines, waiting for the correct moment to step in. And when it does, we will see a very strong positive reaction in the fixed income markets with a tightening of yields and spreads. And the yields are pretty good right now. So if you were to look at yields on a historic perspective, and what this chart shows you is going back to 1997, you have spreads in terms of the U.S. investment grade market, yields in terms of the U.S. investment grade market. And you can see this in the light gray line. On the left-hand side of the page gives you the percentages. So it started off from, call it 6.5% in 1997, and we're at about 5.5% now. So you can see that the market is about 5.5%. And if you were to look at the median investment grade yield over this entire period of time, you see that in the blue line, which is, call it about 4.8, 4.75%. So currently we are well above that particular number. And so that again gives participants of the market the confidence that this is the right time to step in from a long-term and technical perspective. We're going to shift scenes a little bit. We are now going to move on to emerging markets. And in the emerging market space, what you see in the chart in front of you is 3 years of growth. 2023, which is the year that's gone by, 2024 forecasted growth, and 2025 forecasted growth. So these forecasts have come from BMI. BMI is a macroeconomic forecasting shop that is a sister company of CreditSights. And according to their forecasts, we are going to see a minor slowdown in EM growth, but this has a lot of different moving parts in it. We are going to see a little bit of a slowdown taking place in mainland China, Hong Kong, emerging markets, which is European emerging markets, and India. So India has got very strong growth, but that is slowly going to reduce. But we are going to have very strong growth in ASEAN, MENA, which is Middle East and North Africa, and Sub-Saharan Africa. So we are going to spend a little bit of time looking at the APAC region next and what these growth forecasts mean. So on this table, we've got a breakdown of the various growth rates for FY24 and FY25. And taking a step back, what this basically tells us is that the APAC region is in pretty good shape. So in our near territory, it's looking reasonably positive. I've highlighted the Philippines. The Philippines is on a pretty strong growth trajectory. BMI forecasts in 2025 that Philippines GDP growth rate will be 6.7%. That actually is the highest in the APAC region. All these numbers are very strong, whether it's Philippines, whether it's India, whether it's Indonesia, even Malaysia. So lots of momentum there. There's also momentum in some developed markets, South Korea and Singapore, for example. The trajectory is very positive. China is going through some tough times, and I think we're all aware of that. There's a certain amount of stability for 2024 so far, and we'll have to look to the future and see what schemes the government comes up to prop the sector up while a lot of changes take place, particularly on the property side. So we do anticipate, and so does BMI, that rate cuts are expected in 2H24, but the timing is likely to be Fed dependent. Inflation is coming under control in certain jurisdictions, but in other jurisdictions, it's still a little bit of a tough call. Some of you may have noted that in Australia, the Reserve Bank of Australia has hinted at interest rate increases in case inflation doesn't come under control. So that's not out of reckoning as yet in case inflation doesn't come under control. But broadly, we do anticipate that inflation will slowly come under control and that various Asian central banks will largely follow the Fed when it comes to interest rate cuts. In case there are unusual situations, they might cut ahead of that, but then there might be some amount of FX volatility to follow. So looking at where we are right now, the mid part of the year is always a very interesting time to take a look back and say, right, how has the first half of the year been and what does the second half of the year bring to us? So the first half of the year has been pretty good. US growth has been not too bad, the 1.6% number notwithstanding. China, there's been a more supportive policy environment from the government, certainly compared to the previous year. The big superpowers are talking, so that's great. Inflation is slowly coming under control. And very importantly, from a credit market perspective, corporate credit quality and bank credit quality is doing pretty well. This is broadly the case when it comes to the Philippines. The top tier banks are doing very well. The second tier banks are beginning to face some degree of challenges. And in the first half of 2024, we've had Asian elections, which are, again, the results have come out broadly as expected. And oil prices, as a result of the lack of OPEC plus consensus, oil prices have been broadly range bound and again not spiking, which is certainly good news. But where there's been good news in the first half of the year, there certainly are some degree of challenges when it comes to the second half of the year. As Toto said, what if we have the situation where interest rates simply don't come down? What if inflation reaccelerates? The US presidential elections are always an interesting space to watch, and what's going to happen in case we get a Trump administration? What happens in case Biden continues? What happens if the U.S. consumer slowdown is far more than what we anticipate? Is the Fed going to step in then? But if inflation is high, what are they likely to do? And geopolitical escalations are never too far away. I want to spend a short period of time on U.S. Election considerations because this is something that increasingly, as we get closer to the 4th of November, we are asked about a lot. So when we look at the Trump presidency, what are the near-term policy implications? Trump has said that he's likely to put a 10% tariff on imports. On Chinese goods, it's likely to be significantly higher. Tax breaks that had a sunset clause in 2025, which means that there were certain tax breaks which Trump had put in, which he anticipates, which were to go away in 2025. Trump plans to make them permanent. That is going to result in a big jump in the U.S. fiscal deficit, which has already been on an increasing trajectory. This is going to be partially offset by a repeal of some of the Inflation Reduction Act. So that is the act that has provided a lot of funding for climate change. and also student loan relief cancellation. We anticipate an easing in M&A restrictions, pro oil and gas movement, and potential Fed changes. But that, of course, is more in the category of speculation. So, what does this mean in terms of a Trump presidency? At the very minimum, tariffs on imports is going to be more inflationary, which makes the Fed's job a little bit more difficult. And tax breaks being made more permanent means that the U.S. fiscal deficit is going to increase, and that has to be funded, and that has a natural upward movement when it comes to yields. So those are the risks with the Trump presidency. With the Biden presidency, it's continued Congress gridlock. We've seen that it's been difficult for Biden to get his agenda across. He finally managed to get the Ukraine bill passed, but it took an extraordinarily long period of time to get that through. So policy jams will likely continue. With that, we move to our last slide, which is on our outlook. We do have a neutral outlook when it comes to markets at the moment. Whether it is in the table in front of you, you can see US investment grade, Asia investment grade, emerging market sovereigns, or Euro IG. That is because we look at relative value opportunities on a spread basis. What is the spread that is available above a particular benchmark? And the spreads that we see in all of these markets are on a historic basis pretty tight. What that means is that investors are very happy with the yield that they have, but on a spread basis, investment opportunities for institutional investors in particular, they are quite tight, and so we do have a neutral view, bias towards marginally widening spreads on a yield basis, though, given our expectation that yields are going to fall. These are very good yields to start locking into. As you can see, the yields are broadly the same across US, Asia, and EM sovereigns. You can see the yields in the third column over here, and it's, call it the 5.4 to 5.7 kind of range. Euro IG yields are much lower because the Euro benchmark is also significantly lower. So with that, I wrap up my part of the presentation set today, and I will hand you back to EA. Thank you.
Thank you, Pramod. You may already be familiar with our final speaker. He heads the Institutional Investors Coverage Division, where he oversees the bank's relationships with non-bank financial institutions, including government financial institutions, insurance companies, and asset managers. He joined Metrobank in 2016 after 12 years in Singapore and 2 years in London as Director of Asian Equity Sales for UBS, Credit Suisse, and Bank of America Merrill Lynch. Today, he will share his expertise and shed light on the intricacies of fixed income and rates advisory. Please give a warm welcome to Ruben Zamora.
Thanks, EA. Hopefully you can hear me well. Sharing my slides now. We're calling, again, this is more the local view, our view on the macro landscape here in the Philippines and peso markets, but really kind of framing it as a long glide down. And I think Todd already alluded to how mixed the signals have been. Even the dot plot guidance from the Federal Reserve has been somewhat all over the place. But I'll kick things off really with Metrobank's forecasts. For most of you, I think you've seen, I'll just a little help from the pen. You've seen our forecast. We've recently updated some of our metrics for this year and next. But starting with growth, I think we're okay. And again, Pramod and his colleagues do see pretty robust growth here this year and next. We're slightly lower than their optimistic forecast for the year, but we remain optimistic. Inflation is also something we'll spend some time on because we just recently lowered our projections for local inflation this year and next and really a little bit more aligned with what the BSP's risk-adjusted estimates are for the year. Really on the view that the trajectory seems to be cooling a lot faster than our previous projections. So that's something that will influence the policy rate trajectory, the policy rate path, which again, this is really pretty much a moving target for us. We've been trying to anticipate when the BSP will start lowering rates. I think with an average inflation of somewhere around 3.4, 3.5% versus a policy rate of currently 6.5%. That's a very restrictive environment in terms of the policy rate. So we do anticipate some adjustment by the BSP to particularly in easing restrictive rates locally. But our view is and has been and continues to be that that is Fed dependent, similar to the view that Pramod explained for a lot of the other Asian central banks. Ultimately, we see the peso ending the year lower than where we are at now, at 56 or thereabouts. Again, that has to be influenced by and continues to be influenced by where the policy path of the Banco Central will be. And that's something that we will look at a bit more closely. I guess, thoughts that we want to kind of leave you with in terms of our view, we believe that the BSP will lag the Fed despite cooling inflation. Dollar peso may linger, or stronger dollar peso may linger through the further third quarter, but we believe current levels represent limited upside to where it might peak. Meanwhile, on peso markets, we believe that investors like yourselves should position for a slow descent in peso rates, which we also anticipate will be the situation in the U.S. And leading into that kind of backdrop, we do think that there are investment opportunities and portfolio rebalancing opportunities in global bonds and equities, which hopefully we can touch on in some detail in the question and answer portion of the program today. First, on the lagging the Fed, it really is going to be an argument on the inflation trajectory. Growth, as I said, is okay. I think it's actually tracking to where we've been in the past. Last 2023, last year, growth was below expectations at just 5.5%. But really, government spending, which would be the orange line or the orange part of the bar, it has been and continues to be the swing factor. So looking at that, the administration will continue to spend this year and next. And again, their focus continues to be on infrastructure and manpower, healthcare, education, and infrastructure through improved transportation and energy. But really what's important for us also is looking at the fiscal management being a bit more disciplined than previous administrations under the Department of Finance and Secretary Recca. Good growth still projected amidst this a bit more fiscally disciplined regime. What we mean by that is that deficit projections of the government as a percentage of GDP will continue to trend down despite more spending, really to keep the growth engines firing in the Philippines. But what that means for us, particularly after this year, is that the debt, the level of debt and the new issuances, bond supply in particular, will start to taper from next year onwards. And again, this is supported by rising revenue collections. This path of spending for that's projected by the government. It's still rising, but revenues will be rising faster than expenses. Therefore, that's why we do see the deficit kind of shrinking, and therefore less borrowings are needed to fund that deficit from next year onwards. But really, it's all about inflation, and what we feel is key for us is the supply shocks and really fixing and addressing the supply shocks for us. And there's the government has launched this inflation kind of program to really rein in, and hence it's called RAIN, inflation, and really addressing domestic supplies in particular. And of course, we have to really look at rice prices and the fact that the impact on inflation, the level of contribution to local inflation of one commodity is outsized. But we do see that towards the trend with that we saw, sequential trend that we saw in May, the trajectory is starting to really indicate, suggest that local inflation is really cooling down. And with the lower rice tariffs, we are looking at the potential decrease, a much faster, descent in inflation than we anticipated. Now, in terms of the rice, the lower rice tariff, we do think that the impact will be felt in August after hopefully the executive order and the details and implementation of the lower rice tariffs, come into effect. But again, that's a tariff structure that's going to be in place through 2028. So the effect of that on inflation, and particularly because of the outsized contribution of rice to local inflation, will be felt from August onwards, in our view. Very importantly, though, we do think that on our models, that inflation locally will only peak in July, which is in line with some of the guidance from the Banco Central that they do see inflation potentially peaking in June or July this year before tailing off in the second half because of base effects particularly. But we do see inflation cooling down faster than our original expectations, which was 4%. We now see it somewhere upper bound of about 3.6 and lower bound of about 3.3%, with the lower bound being really a factor from the lower rice tariffs. What that means for us is that that allows the BSP to really start their easing cycle, understanding that inflation is starting to reflect that it's starting to be under control. We do, however, expect the BSP to move, not in August, despite some of the recent pronouncements that we've heard from the governor that that's a live meeting, which is actually August 15, which incidentally is the only rate-setting policy meeting in the third quarter of the year. We instead see that happening in August in response to a Federal Reserve cut in their September FOMC meeting on the 18th of September. So we are, again, with July being the peak in inflation in our models, we do see, which will be observable in the first week of August. We don't think the BSP will move that quickly in starting their own easing cycle on August 15 and really wait for the Federal Reserve to signal their intentions and of a cut. Now we're aligned with CreditSights' view that the Federal Reserve will be cutting twice this year, but for us, most likely, we see that happening in September and in the December FOMC meetings, and therefore that opens up the possibility of 2 rate cuts for the BSP in the fourth quarter in October 17 and on December 19. Going forward, however, 2025, we believe that the BSP will move, will be Fed dependent as well in terms of easing from very restrictive levels to towards the 5% policy rate level by the end of next year, following the Fed's 4 rate cut guidance, as indicated in their dot plots. Now, of course, as Dalton mentioned, we might be living with higher for longer and higher forever rates in the U.S. It's been very hard to anticipate where the landing point will be, but we're because of what we're observing in the U.S. Again, feeding off of what Pramod said, that things are starting to slow down, not just on the U.S. consumer, but also in terms of job creation. Some signs there that opens up the possibility for the Fed to start really cutting rates and therefore allowing us to start our easing cycle now. Higher for longer, maybe higher forever. It remains to be seen where the Fed and the BSP will both end their cutting cycle, their easing cycle. But we think the starting point will be this year, again, because of where we see the macro environment is pointing to, both here and in the U.S. But where that ends is remains to be seen. That's why we are looking at this as a long glide down in terms of the descent in rates, both here and in the U.S. What does that mean, though, for the dollar peso? If we are seeing a lot of pressure on not just the peso, but really because of all the other emerging Asia currencies, it is a strong dollar story because of the higher for longer expectation. We think that the stronger dollar against the peso may linger through the third quarter, but we're also of the view that the upside from current levels will be capped. And really looking at the October 2022, if you can look back a year and a half, 2 years ago, we saw that some level of defense from the BSP's open market operations at that level, in October 2022. And of course, if you remember that episode, that's when the Fed was hiking very aggressively. They were in the tightening cycle. But now it's more about how quickly are we going to normalize those rates, or at least when will we start normalizing those rates, the easing cycle. We think some level of defense is starting to come through already at current levels, which is introducing downside risk to the dollar peso. And I think that's really in response to the peso being the worst performing currency in Asia since really the mid-April, since mid-April this year. I think the BSP, while suggesting really very strongly that they're allowing the peso to determine its to be market determined the level. I think some recognition that the peso has been worst performing currency is what's factoring into their own open market operations. We do think longer term, and again, our dollar peso view for 2025 is a stronger level than where we are now for the peso, and even by year end this year. It is because we see the current account deficit narrowing based on, again, the projections of our own and projections as well as the projections of the government. And again, we do continue to see it's really largely on continued remittances coming through. And I think, again, our year-end level of 5610 forecast is there's a seasonality part to it, as we understand, of course, that the fourth quarter is the peak of OFW remittances, while Q3, lingering weakness of the past in Q3 is because that's the peak of importations. What about asset markets in the Philippines and how we would recommend positioning in peso markets? Again, we anticipate that interest rates, it starts and with that and our view that it's going to be a very long glide down. It's a very slow descent in peso rates in line with the pace of normalization of the Fed. When we look at bonds specifically, or first, funding progress is strong. It's tracking ahead of schedule. We also recognize that liquidity that buys into the bond issuances, this bond supply of the government, is still very, very high, particularly relative to the pre-COVID average of about 500 billion pesos, but currently at 1.7 trillion. And even during the crisis or the pandemic years, looking at the last 5 years, we're still very elevated, and therefore those are the ones that are really getting into buying into bonds, and it's really capping upside in interest rates. So therefore, our view on Philippine rates and therefore Philippine bonds is to continue adding to duration. Our target duration for portfolios for investors is around 5 to 6 years. we've already seen the current levels across the yield curve is the gold bar, or the gold line. The peak last year is the light blue line. So we've already moved quite a bit from peak levels last year. But we do anticipate that by the end of the year, we will trace back across the board to the lows that we already saw in March of this year. So it is an opportunistic time now to start continue adding duration, particularly again with the outlook that bond supply will no longer be a big drag uh, on rates as before, given supply is expected to taper from next year onwards. So our view on bonds, on Philippine peso bonds, again, is to continue adding duration, lock in long term. If levels are acceptable, that's our number one number one recommendation. Position as well opportunistically in the front end, in the belly and back end of the curve on any kind of sell-offs. Again, we are still seeing some volatility, but we do see opportunities also in long-term peso corporate bonds as much as our preferred holdings in government securities for peso bonds. For dollar peso volatility, if we do express, we have structured notes that we can help you express your view or our view on the dollar peso. Again, if you agree with our view that the dollar peso will continue to linger in terms of a stronger dollar and a weaker peso over the next 3 months, but that the level will be capped at current levels after 6 months or even 3 months, then there's a way for you to really capture that, you express that view on the dollar peso with the via a payoff of as much as 7.5 and 7, close to between 7 to 7.5% for 3 months to 6 months outlooks on dollar peso. Those are annual rates. So again, this is just a way to express the dollar peso volatility. If you agree with our view that the dollar peso is starting to look toppish at current levels. For equities, we do think that the support level is we're about there. We have a 7,200 end of 2024 index target. It has and the equities, Philippine equities, has been and continues to look very cheap, especially when you factor in the strong earnings projections or strong earnings performance last year, and how that looks, and how conservative our projections are looking for earnings per share for the index this year. In terms of our top sector picks, banks, consumer staples, shipping, and utilities are our preferred sector picks. And again, we can dive a bit more into that during the Q&A. We want to also highlight, of course, that we can express exposure and gain exposure to Philippine equities through our UITFs, including the dividend yield fund of our trust banking partners. Diversifying into global bonds and equities is a way to really capture some of the opportunities that Pramod really introduced to us earlier. In terms of U.S. rates and the yield curve, again, because of the inversion of the yield curve, we would be more tactical in adding duration, if at all. We would prefer, tenors below 5 years, given the inversion of the yield curve. But again, when the FOMC starts signaling more substantially at the start of their easing cycle, we do think that might be the tactical turn and shift back into duration, longer term U.S. Treasury and credits for U.S. dollar denominated bonds. Pramod already highlighted that there's $6.12 trillion parked in short-term funds in the U.S. 10-year average is 5.8 trillion, but I think even Pramod's slide suggested that actually it's closer to to $3 trillion is the long-term average. So 6 trillion is a lot of cash. That's a lot of cash. It's going to be that's parked in really short-term funds that can then find its way very, very quickly into longer-term funds. And so we want to be well positioned for that. And again, some of those ideas, hopefully, we can kind of discuss in the question and answer portion. In terms of our bond picks, in dollar-denominated bond picks, again, these are some of the things we're looking at: rising energy commodity prices, global banks benefiting from gradual interest rate cuts, growth opportunities in the health sector, and of course, the Philippine ROPs is really meant to look at the long-term growth trajectory of our country. In terms of global equities, of course, the S&P 500 has been on a tear and it continues to reset fresh highs, and just illustrating why. I mean, what's behind this is where profit margins have been and continues to go. Stock buybacks have also been supportive of that. But I think for in terms of historical, either year-to-date performance, we're already seeing a lot of performance in U.S. and really because of tech. And so there's some transmission into other sectors in the U.S. But again, for global equities, we would be looking at some of the other markets that we think and other sectors perhaps to help diversify your investment portfolios. And again, last slide for me is a way to express some of these views on global equities, dollar-denominated global equities. Again, there is the feeder fund that tracks the S&P 500. That's of course done very well, but Japan and Europe may be something to also consider for your investment portfolios. Again, we'll leave you with our 4 themes for the second half of the year. It will be a long glide down. We want to look at the easing cycle as protracted. Again, we're looking at the end of 2025, not the end of this year. But our conviction view is that the BSP will lag the Fed in terms of their own easing cycle, despite sharply cooling inflation here. Dollar peso strength may linger through the third quarter because it is the peak import season, but we believe the upside on dollar peso may be capped at current levels. For peso assets, again, we would position for the slow descent peso rates. We're of the view that rates are on their way down. And again, given the outlook on bond supply tapering from next year onwards, we think that's supportive of adding duration. And for global bonds and equities opportunities, we have ways to express those views for your investment portfolios. I'll stop there and hand the floor back to EA. Thank you.
Thank you, Ruben. Now, to proceed on to the most exciting part of our session today, the panel discussion. Ladies and gentlemen, please join me in welcoming our panelists who will join our speakers for today's discussion. First, we have Antonio Cailao, Metrobank's head of global credits trading. Tony brings with him over 20 years of extensive experience in banking, both locally and internationally. Prior to his current role at Metrobank, Tony held significant positions at renowned institutions such as ING Singapore, Barclays Bank Singapore, and Daiwa SMBC Hong Kong. At ING Singapore, he served as director and head of Asia Credit Trading, focusing on clients from Hong Kong, China, and Southeast Asian countries. Joining Tony is Cristina Gabaldon, head of the Investment Management Division at Metrobank Trust Banking Group. Cristina Gabaldon, or Gabs, graduated from De La Salle University with a bachelor's degree in accountancy and economics. She has over 16 years of market experience. She started her career in Union Bank of the Philippines as a portfolio manager and eventually chief investment officer. She then moved to the Bank of Philippine Islands as a senior equities portfolio manager and then as head of equities of Sun Life of Canada Philippines Incorporated. She's also a certified public accountant and a chartered financial analyst. She previously served as a board of trustee of CFA Philippines and is currently part of the board of trustees of the Fund Managers Association of the Philippines as president. So I'm sure our audience has many questions for you. I'd like to invite our guests to send your queries in our chat box, and we will be reading them here for our panelists to answer. So I guess first I'd like to start with a question aimed towards Pramod and Ruben, more on U.S. macro. Going back to U.S. macro, I think really growth continues to worry investors in that part of the world. And we've been seeing some conflicting economic data the past few weeks. A couple of weeks ago, we saw a lower than expected job vacancies in the U.S., higher claims for unemployment insurance. So initially seeing some slowdowns or some weakness in the U.S. labor market, and suddenly May non-farm payrolls come out greater than expected. So I guess just want to get, for context, what are these kinds of jobs that are being added, and assuming they are good quality jobs, do you think that people, the U.S. people in the U.S. labor market, can they continue to fuel the consumer spending that we previously saw, and that you think might be threat of slowing down?
That's great. Maybe I can have a first stab at it and then hand across to Ruben for his thoughts as well. No, you're absolutely right, EA. There's been a lot of information that's been coming out, and sometimes the information is positive, sometimes the information is negative. I think the information that has come out has been very much in line with some of the slides that I was talking about, in that the consumer is definitely coming under some kind of pressure. And you're seeing that in terms of retail sales. You're seeing that, as I said, we've got a lot of analysts who are looking at all of the data that is coming in. We're seeing that people are trading down in terms of their purchases. We are also hearing a lot more of CFOs on investor calls. They're not talking about hiring; they're talking about reducing workforces. So overall, it does look like the employment environment is looking more challenging, and then you have these big jumps in non-farm payrolls that then don't really mesh together. So these seem to be more one-offs, or maybe there might be a little bit more of that to follow, but not a lot to follow. Some of that is hiring in the government sector, some of it in leisure and hospitality. There's a little bit of healthcare too. That's being added. So these are the main sectors where it's being added. But at least in terms of leisure and hospitality, it's looking like you might not see those kind of jumps going forward. It also looks like in the government sector that there were certain funds that are still available from the COVID and other times that have a use by date. So maybe there are other government schemes that come out, and therefore there's more government hiring to follow. But at least for the near term, we're thinking that those jumps that we see are likely to be less so. So we are on the more cautious side. We are seeing some amount of slowdown happening. That's also, by the way, in the rental part of the economy. So in the early days when inflation was spiking, this was due to autos being very expensive, which in turn was due to a chip shortage. Secondhand autos were very expensive, and home rental was very expensive. Now, car secondhand sales values have steadily been coming down, so it's disinflationary, and the rental market is undoubtedly softening. Some of the information that the Fed does look at is necessarily backward, and they need to forecast, but more the real-time data that's coming through is definitely talking about softness. So with that, I'll hand over to Ruben.
Thanks, Pramod. You guys are the U.S. experts we rely on, but I think from our observation from here, is that U.S. inflation has fallen already from a peak of 9% to, 3-something, and even core inflation is below 3. I think goods inflation has already come off quite sharply with a lot of the COVID induced supply disruptions fixed. Now it's housing and vehicle pricing that we need to anticipate. And as you just said, as you just alluded to, Pramod, I think that's also starting to come off and may come off fairly sharply. So on the job side, yeah, we're mindful that you know they've been kind of strong and but I think the outlook on job softening, we're also of that view, and therefore quite we're in the two cut camp, and that's why we're sticking with our September the September easing cycle start.
All right. Thanks for that, guys. Another question here, and I guess I can combine the questions together. So we have a client, and then we've had clients ask this question even since last year. In Pramod, you mentioned in your slides, even in the event of a Biden presidency, congressional deadlocks, and in a way we've been experiencing that already. Last year, you know, the U.S. had to suspend its debt ceiling to January 2025. That has allowed the U.S. to issue more U.S. Treasury securities. So we've had clients, and here, even here in the chat box, we have clients still asking, is it still safe to invest in U.S. Treasury securities? Is it still safe to hold on to the U.S. dollar? And especially considering that, Fitch, which ironically is your parent company, downgraded the U.S. from AAA to AA positive last year. What are your thoughts on I guess on debt ceiling concerns, and if there will continue to be deadlocks in Congress about that? And maybe Tony, after Pramod, Tony, maybe you can chime in on your thoughts on the Treasuries market as well.
No, you're absolutely right that that's a concern that is there and is likely to continue to be there so long as you have a president and Congress who are from different parties, because agreement will not be reached. It'll go down to the wire. And then hopefully an agreement comes through. Every time an agreement comes through, there's definitely a sigh of relief, and then the stage gets set to when it gets postponed to next. So hopefully we do have an agreement and things move forward. There is that's kind of become a little bit of the political theater, shall we say, that we've been seeing over the last couple of years, and we've managed to work our way through that. So hopefully that will continue. On your other point about fundamentally U.S. Treasuries, the answer is yes, because it is, although there have been a number of challenges that have come through to the U.S. dollar and a number of challenges that have come through to the U.S. Treasury just from an investing point of view, it just remains the preeminent currency. It remains the preeminent form of investing, and it doesn't look like there's anything that's going to challenge that. As an ironic riposte, you might recall the time when S&P had downgraded the U.S. first from AAA to AA plus. At that point of time, there was a run to safety, and the treasury yields actually fell at that point of time. So the markets behave in funny ways. I think the rating agencies also have their own criteria on where are deficits and how does growth look like and what do political systems look like. So everybody has their own way of interacting with all of the different information that's provided.
Yeah, and our take really on the dollar, it's like there's no real substitute for the U.S. dollar. So hence, it's always going to be sort of the safe haven. It's always going to be the main currency for now. So we do believe in some diversity in terms of FX. So the dollar will always be there. And going to the point of the debt ceiling, I think that's always going to be an issue each year, given the sort of deficit they have versus the income, the tax revenues versus what they have to pay for. So that debt ceiling is going to be a kind of like the way of life for the moment in the bond market. But again, treasuries, to us, it's still at this stage pretty much the risk-free debt instrument. Yeah.
All right. Thanks, Pramod. Thanks, Tony. I think we have one more question. It's directed to Pramod, but I'd like to involve Ruben here as well. It's on Philippine growth. And Pramod, in your slides, you showed you showed that BMI. Well, BMI is an affiliate of CreditSights, but they're forecasting 6.7% GDP growth for the Philippines in 2025, and that's interesting because um, coming from an offshore entity forecasting something higher than what even local entities would forecast. Would you happen to know what are the drivers for economic growth for that 6.7% forecast?
Great question. I wish I would have, but unfortunately, I didn't spend a lot of time in terms of what the 2025 number looked like. So the good news is that it's a secular trend, so it isn't something that's particularly bumpy. It's definitely headed on the way up. But I will defer to Ruben for his insights, and maybe I can circle back to you at a later point of time with some of the numbers and insights that BMI has.
Sure, sure. Thanks, Pramod. Ruben, well, you spoke at length about how government spending is really what's going to be the swing factor for Philippine growth. But your thoughts on consumer spending, will that continue to remain robust in the country?
Yeah, short answer is yes. Again, if you look at the breakdown of what's on the expenditure side, I mean, government spending is a swing factor, but it's not the biggest factor. The biggest factor is local personal consumption. That's been holding up even in the pandemic years. What we saw in 2023 is very little government spending. And what really held up the economy is no investment or capex spending by corporates as a result. But what really held up and gave us 5.5% growth from an elevated level in 2022, 5.5 from 2022 levels, it was personal consumption. That's 67, two-thirds of the economy is personal consumption. So yes, robust. Even we've seen how resilient that's been even in crisis years, and we don't anticipate that to really change. There are structural drivers to that. I think one of the big global houses actually came out with a demographics report this morning about how favorable the demographic tailwinds are still for the Philippines. We're still the youngest, really, demographic in Asia, and those dividends will continue to pay through for an extended period of time. But what we really need in 2025, hopefully, will be a story of investment spending from the private sector catching up. So again, government spending and our own team, our research team's done a lot of work on what's being accomplished on the ground here, and we're seeing it. And I think the continuation of that, and then what we believe is a lag effect of private sector spending, two quarters or so later, will be hopefully what we'll see and what we anticipate will happen in 2025. Again, thank you for BMI looking at 6.7%. We're somewhere around to 6 to 7. Hopefully, we'll be closer to 6.7 than 6. And again, I think within the context of what the government, particularly the executive branch, the Department of Finance, really being more fiscal hawk and more disciplined about big deficits and trying to scale that down. But we are seeing substantial. That's why we wanted to show it, because there's a way for us to actually continue spending without having to borrow more.
All right, thanks for that, Ruben. Next question, I think I can direct this to Tony more on really just the credit space now. And Tony, if you remember in Pramod's slides, he showed there how U.S. investment grade seems to have the wider spread at the moment because Asian investment grade supply really not as available. Wanted to get your thoughts on that, especially given this U.S. narrative about how the rates are coming down, not quite there yet, but they will be coming down. So do you think US IG is really the way to go, or do you still see better opportunities in the Asia investment grade space?
Well, we're a little biased because we're Asia based and we like to invest close to home. Especially, it's hard for Asia to track what's happening in the US or Europe or globally. Although, it's always about diversification, but I would say for Asian investors, especially Philippine investors, the allocation should weigh a bit more in this region. And even if you look at sort of Pranod's charts, Southeast Asia and APAC in general, the growth is still there. The only problem, though, with the Asian bonds external debt is the valuation. Yes, it is tight. It is tight versus U.S. at some spots, but it's tight for a reason. It's because there's just not enough supply. We only had something like 75 billion worth of supply this year so far, and 180 billion will be maturing this year. So the net effect of our bond market is actually negative. Um, Hence, the spreads are very tight. That said, though, we still find value in a lot of the Asian bonds. Our favorite is still Southeast Asia, and we are trying to take advantage of the inverted yield curve. Because of this inverted yield curve, we find that the 5-year and shorter is where the value is. You can pick up bonds anywhere between 5.5, mid fives to high fives, if you hunt properly. Um, Again, to compare that to the 5-year U.S. Treasury at 4.2, you still get a bit of a pickup. And especially, again, for Philippine investors, you don't have the 20% withholding tax on these dollar bonds.
And is there like a specific, I guess, part of the curve, or what's the ideal duration? I think Ruben mentioned, well, for the pesos, at least 5 to 6 years. On US dollars, are you looking at something similar as well?
Well, really, if you can find it, the 2-year bucket is the cheapest bucket, 1 to 2 year. But again, there's a bit of scarcity. There's a bit of a scarcity issue right now. Although it can still be found. The liquidity right now, again, like I mentioned, the bond market, Asian bond market, is pretty thin because of the lack of supply, net negative issuance. But it's still priced cheaply on that part of the curve, the 2-year bucket. Just looking at, for example, let's just look at some Philippine corps. There's some 2025, 2026 bonds, 27 bonds, still giving you in the mid to high 5%. So in event of whether the Fed hikes or doesn't do anything or cuts, that you won't feel too much pain from the mark-to-market point of view, although you still get that yield and carry. And if and when the Fed does pivot and cut, that whole front end will reprice, and you'll start to see that yield curve invert. So again, a really good chart by Ruben and his team that shows the U.S. Treasury yield curve. I mean, that's also reflected in the Asian dollar yield curves as well. Yeah.
Thanks for that, Tony. I guess also going, because you also overlook peso bonds, that market maybe not as liquid as the global credits markets, but what opportunities do you see in the peso bond space now?
So the peso bond space, 5-year the 5-year bucket to 10 years actually where the value is. In fact, if you think the Asian US dollar bond market is thin, in fact, the peso bond market is even thinner. And again, scarcity of value, very hard to find. Every time there's a new deal, it gets locked up. It's a little harder to find bonds. However, there are still some pockets of liquidity, and you can find it in the 5 to 10-year parts of the curve. The yields, roughly gross yields, are giving you anywhere between 6.5 to 7. That's before withholding tax, though.
Right. Thanks for that,
And
Tony.
again, most of the
Oh,
names in Phil Corps are very good names from the Ayala
mhm.
lands, Ayalas, the Conglos, some of the financials as well.
Right, right. And I think we did see that with the recent SMPH issuance,
Yeah,
pretty much ran out like in the first 2 days of the offer period. Um,
pretty much.
Gabs, I want to move on to you next, since we can maybe still talk about fixed income, but equities as well. Um, a lot of those in the audience primarily are peso investors, but there's always been that study about how you need to diversify and consider some foreign currency denominated assets because you want to go into assets that don't move directly, or along with or are highly correlated with your peso assets now. So I guess my question for you is, looking at dollars, pesos, uh, fixed income, equities, what's your recommended asset and currency allocation?
Okay. Thanks, EA, for the question. Um, it all depends on your benchmark and your risk profile. So let's say if you're 70% fixed income, 30% equity type of investor, my recommendation for you would be go 72% fixed income, 28% equity. So there's really a bias right now for fixed income. And our call is to overweight duration, given that rates are high right now and expectation is that cuts might happen soon. So why not lock in at the rates now? So for us, how we play it is we're overweight duration. We only play the amount of overweight versus the benchmark. For equities, though it's cheap right now, it has its challenges. Dollar peso is a concern. So foreign investors look at the forex component as eating up on their expected returns, right? And companies that import raw materials have contracting margins unless they could pass this on to consumers. And if they're able to pass this on to consumers, which means higher prices, revenues might be at risk as consumers seek more value for money propositions, and down trading happens and such. Also, companies with large unhedged dollar liabilities could find their interest payments to be more costly. And in terms of benchmarks, let's say MSCI or FTSE, the weight of the Philippines there has been declining, and a lot of foreign investors follow those benchmarks. Did you know that Philippines is only 60 basis points of the MSCI right now? So quite gloomy for the local equity market. If we're thinking about currency mix, I would say go 80% peso, since we are Filipino investors and we spend using peso, and 20% in dollars. Diversification of currency is always good.
All right, thanks for that, Gabs. I want to focus on the dollars first, I guess, dollar equities stuff. It's a hot topic right now. If you look at over the last 5 years now, pre-pandemic, if you had you invested in dollar equities or the Philippine Stock Exchange in 2019 and held it for the last 5 years, I think the PSE, you'd still be down 6%, but you would have doubled your money in the S&P 500. Um, but we seem to it seems to be a deja vu moment now, how there's really a lot of optimism in US equities because of AI. Um, 20 years ago, 24 years ago, during the dot-com bubble, we did see this kind of similar behavior of investors really pouring a lot of money into tech that was had not yet been proven. But of course, over the long term, we saw companies, Microsoft, Amazon, Apple, really come out and really like grow into what they are today now. Your thoughts on the S&P 500 or the Nasdaq with this with this optimism on AI? You think it's overdone already, or do investors, are there still opportunities for investors to participate in US equities even at these record high levels?
So S&P right now is at 5490. Year to date, we're up 15.04%. I think it would be best to wait for a pullback. We see support and resistance at 5350 and 5500 respectively. And S&P multiples trading at quite expensive levels at 25.71 times. Historically, during election years, there's been a 5 to 10% pullback months headed into the elections. And I guess wait for that pullback. Long-term wise, we are positive on tech. Expected EPS growth is at 29% for 2024, 17% for 2025. And, the tech industry continues to be among the top performers this year. Top 5 contributors to earnings growth for Q1 2024 would be names like NVIDIA, Alphabet, Amazon, Meta, and Microsoft. I guess AI and cloud computing are among themes expected to drive the most growth in the sector in the upcoming years. So overall, we are positive on tech, and given the strong earnings and given the continuous demand for generative AI applications.
All right. Thanks for that, Gabs. I guess one more also on global equity. So US aside, Ruben also showed some slides about Japan and Europe. There are ways for our clients to gain exposure to those countries' equities markets through our UITFs. For those regions, Japan and in the Eurozone, I know it's not tech. It's not quite tech over there, but what other sectors are you currently bullish in when it comes to the non-US space?
Oh, okay. Well, for the non-US space, it's best to play it via the country selection. So we are bullish on Japan. Because of the reforms they've done, it has improved the profitability and price to book of companies listed in Japan. There's a huge share buyback totaling $65 billion, and this has increased shareholder return. And Japan is experiencing normalization now after an era of negative interest rates. So we're positive on Japan.
Okay. All right. Thanks for that, Gabs. I guess we can go into local equities next now. So I did mention it's been 5 years. PSE still down if you've held it since 2019. Maybe worse if you've held it for much longer. Why is it, Gabs, that really what makes our local equities market so dependent on foreign flows, and why aren't they coming here?
I would say it's really the currency, which I mentioned earlier. And it has this effect of drying up liquidity. So if foreign investors are not here, you would see turnover like just 2 billion pesos sometimes. And yeah, that's how it is. So some reforms are happening, like broker commissions are lower. But I guess we need more sort of structural reform to attract foreign investors. Well, another thing is that a lot of the foreign investors invested in markets that are have tech or healthcare or those type of investments. And here, what we have are the sort of old economy type of industries.
All right, thanks for that, Gabs. And actually, there was also a client who asked now, and given the 7,200 target for the PSE for year end now, so we have a client who commented PSEI was projected to end 2023 at 7,800, but closed at the 6,450 level. So, what do you think makes the 7,200 projection realistic, given that we missed that target in 2023?
So the 7,200 assumption is that we would have 2 rate cuts this year, which would lead to multiple expansion. So we're looking at 12.6 times multiple with the 7,200 target. Right now, market is at 6,366. That's around 11 times multiple. So So the rate cuts need to happen for PE multiple expansion to happen. Of course, we would like a stable dollar peso. That would help as well.
All right, thanks for that, Gabs. I think we have time for one last question, so this one can go to you, Gabs. It's on the UITFs that Ruben presented on the peso ones. So our clients are already familiar with the first two. One is the Metro Equity Fund, wherein Trust tries to beat the benchmark, which is the Philippine Stock Exchange. The other one being your Philippine Equity Index Tracker Fund, which just mirrors the performance of the stock exchange. And you have a new one, which is the High Dividend Yield Unit Paying Fund. Can you maybe tell us more about this relatively new fund, I believe, or it was a revised fund, I think. You had it before, but there were some changes in the mechanics of the product.
Okay.
What sets it apart from the current, or at least the previous offerings?
Okay, so the Metro High Div Yield Unit Paying Fund aims to give investors both income and capital appreciation from listed companies in the stock market. So we have a preference for stocks that have good cash flows and pay regular cash and special dividends. So the fund is comprised mostly of utilities, REIT names, and a bank that pays very good dividends. So the Metro High Div Yield Unit Paying Fund distributes the dividends directly via regular cash payout to the investor. It's credited to their settlement accounts. And this fund has actually performed very well. So in 2023, the total ROI of this fund is 4.725% versus the PCOM's negative 1.77%. And year to date, 2024, the ROI of the fund is 13.99% versus PCOM's negative 1.26%. So there you go.
Yes, I think, and if I'm not mistaken, I think it might be the only fund in at least in the local industry that pays out dividends directly to the investors. Normally, the other funds like your Metro Equity Fund, even your Philippine Equity Index Tracker Fund, dividends are just reinvested in the fund, right? So
Right.
this one actually pays out dividends so that clients have regular cash flows now.
And they can use that for their spending needs.
All right. Okay. All right. Thank you for everyone for your questions. We'd also like to thank our speakers and panelists this afternoon. Pramod Chanoy from CreditSights, Ruben, Tony, and Gabs from Metrobank. In the interest of time, for queries that we weren't able to touch on earlier, please send them to your respective relationship managers or investment specialists, and we will revert to you. So before we end the program, we would like to request for a few minutes to answer our short survey. We'll be flashing a QR code on the screen. We have the QR code. So your feedback would be most helpful for us. There it is. As we continue to develop valuable content and insightful economic sessions with you. So again, thank you everyone for joining us this afternoon. Have a good day.